I think it's better if I sort of step back and walk you through the four types of change of ownership loans you can do, because each is going to have a different down payment requirement. And I'll go through these quickly, but
Okay.
it'll be a good way to sort of break it down. So one are going to be individuals, or an individual looking to buy a business, and they're looking to buy 100% of it. So if you've got a contractor client, they're looking to sell, and they hire a business broker, that business broker takes it to market. They very well could have competing contractors or strategic looking to acquire them, or it could be somebody who's quitting their corporate job. Maybe they have a good background in construction, or they work tangentially to the construction industry, and they want to buy their own business. So in that situation, it's an individual buying a business, an outsider. There is a 10% down payment minimum requirement that SBA has. Okay. I will tell you that, especially when it's a contractor being acquired, that's not going to do it for most banks. That's a really over levered contractor, 90% acquisition debt. We're going to want to be talking to somebody who not only can afford SBA's minimum 10%, but has additional dry powder, maybe to bring the leverage down, or to just put day one capital on the balance sheet post acquisition. So I encourage people listening to this to not get enamored with, oh, all I need is 10% down. Now, as of starting August 1st, SBA did introduce some nuances to seller debt that can play a role in the 10% down. So here are the rules. If the seller takes a note back and it's on full standby, which means no payments for 2 years, that seller debt can be counted towards the 10% down payment. So there is a universe that exists where somebody could buy a business with nothing out of pocket through that scenario, where the seller puts their debt on full standby for 2 years and the bank does a 90% loan to value SBA loan. That's probably going to be few and far between. And I would be careful if you're talking to a lender that would allow that. That's really irresponsible lending in my point of view. You're not going to be set up to win from a balance sheet point of view. And I doubt you're going to see lenders, especially in the economy we're in right now, looking to do 100% financing on change of ownership. It's the riskiest lending a bank can do. But it's out there. The other rule that they rolled out is if the seller carry is on interest only and the buyer's bringing at least 25% of the required 10% down, so really they just need 2.5% down, and the business can debt service the interest payments on the seller carry note, then yes, you could do ostensibly 97.2 or 97.5% loan to value with the seller carry. But again, I'm not really sure why SBA did that. They have changed their down payment rules on business acquisition several times over the years. It used to be 25% required, then back up to 10%. Then they were silent on it. Right now, I think most lenders are moving into a universe where we're just comfortable with 10% down minimum. And we're not really going to mess with that seller carry nuance. So that's a business acquisition. There's also strategic acquisition. That's where an existing contractor is buying another contractor. And if those contractors share the same NAICS code, 6-digit NAICS code, and they're in the same geographical area, SBA doesn't consider that a business acquisition. They consider it an expansion. And in those situations, the down payment rules go out the window. And what instead we're encouraged to do as lenders is look at what the combined, and by the way, I see you taking a lot of notes, Martin. I do have a side-by-side guide that breaks all four of these out
Okay.
really clearly to help you, because it is complicated. So if it's a strategic
Well, I'm not
acquisition,
going to explain a lot of this to people. I
yeah,
guarantee you, I'll put them in touch with
yeah,
you
no
guys.
problem.
But it's for me.
In those situations where it's a contractor buying a contractor, we're going to want to look at the combined pro forma balance sheet and obviously the debt capacity repayment of the newly combined entity, just to make sure that it makes sense. And if it does, then we could possibly do 100% financing. We've done a few of those in a few situations, especially if the buying entity is really strong financially. Otherwise, if
Yeah.
it looks like on a pro forma basis, it's going to be a little over levered or there's too much debt, for the business to cash flow, we still reserve the right to ask for an equity injection or a down payment. So that's strategic acquisition.
Yeah.
The third type is called a partner buyout. And this is where there may be 2 or 3 or multiple owners. And let's say it's a father-son. The son is ready to buy out the father. They own it 50-50. We can do a loan for just the purchase of the father's 50%. And in those situations, if the buyer has had 10% or more ownership in the business for the past 24 months with the same level of activity in the business as a manager, then they can qualify with possibly 0 down. But there's also some financial hurdles the SBA layered in. For example, the debt to net worth ratio on the balance sheet historically and on a pro forma basis needs to be below 9-to-1. And if all those conditions are met, then you can do 0% down. Otherwise, a minimum 10% down payment will be required.
Yeah, I feel like those last two, Cashin, are probably what our audience would be the most interested in. I don't know that a lot of our audience is looking to buy or acquire businesses that are outside of, what they're currently doing typically. And there are definitely cases that I can think of where individuals that listen to this podcast would do a buyout with a partner, or they would do a strategic acquisition. And I think that a lot of people that are, in our target audience, they think about growth for their company, and they're always thinking about, okay, how can I maybe run some ads or hire a salesperson, maybe add a new service that will expand our offering to our customers. But growth by acquisition is a really good means if they're doing that strategic acquisition like you talked about, and they may be able to do that in a fashion that's completely financed by the SBA. So very interesting to hear that side of it.
When that's exactly what we're seeing in our loan pipeline, it's almost, especially for contractors, it's strategics. They catch wind that one of their competitors is for sale, and they're like, oh, this would be a great opportunity to consolidate, or there's a partner buyout. That's the majority of our business acquisition pipeline right now. Mm-hmm. But August 1st, SBA is rolling out a brand new change of ownership, which I think is going to be extremely popular. And this is called a partial buyout. This is where a business can sell a portion of their company, but not all of it. So the other 3 that I mentioned, the seller has to sell 100%. And the seller cannot stay on as an employee. It's a full change of ownership. They can stay on for a year as an independent contractor to help with the transition, but they can't hold a meaningful role. They have to sell 100%. They got to walk away. Partial buyout introduces a new paradigm to SBA lending that's never existed, where a seller can sell a portion of their business to a buyer.
I'm sorry to interrupt you, Cashin. Is this the 4th type?
This is the 4th type. So you have business acquisition, where individual buying a business, strategic acquisition, like-kind business buying each other, partner buyout, and the 4th is partial buyout. So this is an outsider coming into the business and saying, I want to buy it. So here's where we think this is going to work the most. You've got a contractor, maybe an absentee owner, built it up over 20, 30 years, and just has a great general manager or COO that's been sort of running the business for the last 10 years. And they want to sell to that person because they know that person knows the business the best, is most likely to keep all the employees, understands all the relationships with all the prime contractors and all the subs, and they know it's going to be the least disruptive to their business. The problem is that person probably hasn't accumulated, a large enough cash reserve to afford the minimum down payment of 10 or 20% or whatever the bank might require. In this scenario, a non-owner buying in can maybe buy 20, 30% of the business, and in certain situations with 0 out of pocket, so long as the financials of the business show that they can absorb it from a leverage and a cash flow point of view. So this way, they sort of get to buy in a little bit, make sure it works well, being owner, co-owner, and then after a couple of years, they can come back and purchase the remaining percentage ownership through a partner buyout loan. So this is very common. We see businesses wanting to sell to key employees all the time, but the key employees just can't afford the 10% down. We're excited to see what this looks like. One thing that I think sellers will have to get mentally prepared for is they will most likely be asked to be a co-borrower or guarantor on the debt that the buyer is going to use to buy a portion of their business. So we'll see how that plays out mentally in the minds of sellers, but that's a new program rolling out August 1st.